Now, ladies and gentlemen, the very first thing before I introduce audit risk here that you're supposed to know are the relationships between these practitioners. All right. So we have the audit firm, we have the shareholders of a company, and then we have, in this case here, the directors. So remember, it normally starts with shareholders. It normally starts with who? With shareholders. So shareholders, like for example, could come together, all of us here, like say 1,000. And then we do what? We contribute, each of us, for example, 1 billion. That will be a lot of money. We contribute in this case here, for example, just 1 million Kenya shillings. So if that happens, then I will be having 1,000 millions, which is the same as 1 billion, 1 billion, 1 billion. So once in this case here we have 1 billion, we'll be able to say, hey, let's in this case here invest this money, for example, in a college called RCM Limited. Yeah, in this case here, college with what here shares. And then we give these shares here to who? To the shareholders in accordance to the agreements. There are others, in this case, you put in more money, they get more shares, etc. But now there is one thing that we must agree, ladies and gentlemen, between all of us, that these people, 1,000, cannot sit at Nairobi headquarters, where RCM here is based. And then they start managing all of them RCM. It's not possible. So what they shall do, they'll be able to look for a team of, say, 10 people in the name of executive directors. So in the name of executive directors, and these executive directors now will be the ones who will be running the day-to-day operations of the company. These other 990 will go back home, wait in this case here for reports and results. All right? So they go back home. Now, please listen. When these 10 people, the executive directors, are appointed, we expect them to run the company professionally. That's why we chose. We said this person is capable of running this college very well. So please go be in the board. So 10 of them, right? So then number two, apart from running the business, we expect them, in this case here, to prepare financial statements. This is one of the requirements here. They have to prepare financial what year? Statements. So remember, these financial statements, they'll not just be prepared anyhowly. They must be prepared in accordance to the agreed international framework. So they must prepare financial statements in accordance to what year somebody, IAS, or what year IFRS. And then number two, remember, once we have appointed the 10 people, automatically they become our agents. They'll be doing this business on our behalf as shareholders. So there is what we call an agency relationship. For example, like right now here, I could be wanting to buy a great building in town for the college here. And I may not be having that prowess, that knowledge of buildings so much. So in that case here, for example, I could appoint one of you, for example, your CPA Dan. So I talk to CPA Dan. In this case, CPA Dan is able to procure, for example, this house on our behalf, on my behalf. So automatically, I would have done this job. But simply because Dan seems to be knowing so much about buildings, I'm passing on the baton of doing this work to Dan on my behalf. So then Dan becomes my agent. And once he becomes my agent, then there will be what we call fiduciary, 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 fiduciary responsibilities, responsibilities, fiduciary responsibilities, fiduciary responsibilities. So fiduciary means what that we expect them to do everything in good faith, representing our interests at the very best. Among us, the fiduciary responsibilities is the preparation of what your financial statements here. And they must, in this case here, prepare financial statements in accordance to what here, this IFRS. They must prepare these financial statements in accordance to these IFRS here. Now, ladies and gentlemen, please listen and listen to me very well. So you see, at the end of the day, the financial statements they prepare may not be correct. They may be misstated. All right. They may not be complying with the international accounting standards or international financial reporting standards. And that is why these shareholders, now they need to think of a third person, a third person, a third party who will be coming in as an expert to come and look at the financial statements that have been prepared by these executive directors. So this third party is the one now we are calling what here? An auditor, an auditor. And now remember, before I introduce this audit risk, ladies and gentlemen, the auditor must be independent of these executive directors. They must be independent of the executive directors. And that is why, as we appoint them, they must look at the ethical guidelines. Ethical guidelines. They must go through that check list of what are the ethical threats. Ethical threats, and I don't want to cover this today, but remember the acronym of SAFIS, Mr. SAFIS. If you remember this acronym, that will be enough. Mr. What here? Mr. SAFIS. So as we appoint the auditors, we don't want to have auditors who have some prior relationships with these executive directors. Because remember, these auditors are supposed to come and check the work of these people and give an opinion. So if they have some prior relationships, perhaps in this case here, this executive director and these auditors were partners previously out there, or they could even be current partners in some other engagements. They could be, for example, relatives. Then that will not be able to work very well for the shareholders. The shareholders really would love this concept of what here? Independence. The concept of independence is not clear enough. Are you able to hear Mwalimu? Are you able to hear Mwalimu? Are you able to hear Mwalimu? Thanks for raising that. Are you able to hear Mwalimu now? Ah, great. They are able to hear Mwalimu somehow. It's clear now. Okay, great. Thank you for that. So in this case here, we expect, ladies and gentlemen, these people here to be what here? To be independent. We expect them to be independent. Now listen. Listen and listen to me very, very well. Listen and listen to me very, very well. Now, as we talk about, now we have the shareholders here of RCM. We have in this case here, the executive directors, and then we have in this case here, this person that we are calling who? The auditor, who is coming to review the work done for this, so that these particular statements prepared here will be credible enough. These people now will be able to trust them even more. Once the auditor has given them a green light and say that these financial statements are okay, so the shareholders and the other stakeholders will trust the financial statements will be more credible, Now, ladies and gentlemen, remember as we come now to audit these financial statements, there is that risk that whatever opinion we are going to give may not be correct. And that is now what introduces me to this concept here that makes so many of you fail in your exams. What we call audit, what here? Audit risk. What we call audit risk. So by definition, is there somebody who can just try, just assist here by your own language? What do you understand by these particular terminologies here? What is audit risk? What is audit risk? In your own language, what is audit risk? Then I'll be able to tell you why people fail in these papers, AA and AAA, every other day, and yet these are the easiest papers. What is audit risk? Please give me your definitions. Give me your definitions kindly. Give me your definitions kindly. Give me your definitions kindly. What is audit risk? Ladies and gentlemen, audit risk basically is the possibility. It is the probability. It is that chance that an auditor may end up giving an inappropriate opinion, may end up giving a wrong, if you allow me to use that, may end up giving a wrong opinion when the financial statements are materially misstated. when the financial statements are materially misstated. How I wish somebody was able to prompt me with that AI which takes notes for you. There is that AI that takes notes for you. That AI would have been the best in this regard so that you guys can concentrate seeing what Mwalimu is saying than you guys writing so much. There is this AI that takes notes on your behalf. That AI is a powerful tool. That AI is a powerful tool. I've turned it on now. Great. I've turned it on now. So the audit risk, risk means what? A chance. It means what, ladies and gentlemen? Possibilities. That there is that possibility, that this auditor may end up giving an inappropriate conclusion, inappropriate audit opinion when financial statements are materially, the key thing is materially misstated. Remember, financial elements are said to be material, not financial statement, but elements. These elements in the financial statements, they are said to be material when they are of a significant value. So I'm not your normal auditor who will simply get to audit clients, and whenever we see trivialities, small things, we start in this case here running up and down and saying that, in my opinion, these financial statements are what here? They are bad. No. We are here to look at significant matters. Values that are significant, higher value. Those are the material things. So if, for example, I ought to have said that I'm giving an adverse opinion, that these financial statements, for sure, when I looked at them, I ought, if I'd put in proper systems here to give me proper evidence, all right, I was able to dig down enough, and I was able now to base my opinion on this adequate evidence, then I would have easily said that these financial statements, or in my opinion, the opinion here is adverse. That's what I should have said. If I don't say like that, and then these financial statements are materially misstated, then that one we call it what here? Audit risk. This audit risk has got three elements. Is there somebody who is able to remember the three components of audit risk? Is there anybody who is able to remember the components of audit risk, ladies and gentlemen? There are three components of audit risk. Three components of audit risk. Do you know them? And then I'll be able to tell you why people fail. So we have inherent risk. So we have here inherent risk. We have inherent risk, yes. We have in this case here control risk. Thank you very much. And then lastly, we have detection risk. So we have here detection risk. So, ladies and gentlemen, remember, this inherent risk is that risk that we may end up, having frauds, errors, due to the nature of the business. There is no way, if you're talking of a bank, whether you like it or not, you can't get all eggs of a bank getting into just one business. It's money business. Money, in this case here, business attracts every kind of every kind of a thief from outside here. So banks will be susceptible. They will be susceptible, all right, because of the nature of what your business. All right. Then we have in this case here control risk. Remember, every company has internal controls. Those internal controls may not be like 100% foolproof. Even the very best of goalkeepers, like which team in this case here has the very best goalkeeper? Which team? Can somebody, I know you guys watch football. Which team has the very best goalkeeper? Yeah, so you have a goalkeeper there controlling. Like now, somebody is saying Arsenal has the best. Jenny is saying Man U has the best. Man City has the best. Thank you very much. Assuming it is Man City which has the very best goalkeeper. Assuming it is Man City that has the very best goalkeeper. So it's a very strong control. But do you want to tell me that there are no goals which are normally scored against Man City? Do you want to tell me that guy is able to protect all balls? Is he able to protect like all balls? Is he able to protect all balls? No. At times you'll get one or two. So fine, it's a strong internal control. But there is that risk that still errors and frauds will still be there. It can't be 100%. It can't be 100%. Now, detection risk, ladies and gentlemen, now this is the risk that the auditors procedures, the auditor's tools may not be able to identify those errors or what you're frauds. Because the auditor, we are going to try our best. It's not our primary duty to identify errors, frauds, no, but we're going to try our best. We shall be able to put in our best safeguards. But even that, with that kind of safeguards, you may not be able to detect everything. All right. Now, ladies and gentlemen, nowadays, okay, for the AA, you can get them asking this kind of a question here, like define, define, define. But even them, nowadays, what will happen? You will be given a case question. I've marked audit severally, not once, not twice. And I've gotten, in this case here, students calling me, like there is one who called me yesterday, some great friend of mine from a big, one of these big four, I'll not mention the name. Yeah, telling me that, Mwalimu, we normally do this audit at the workplace. All right. But when I did this paper, thinking that I would have passed, I still got what here, a fail. What is happening with this paper? And this is not the only one. Every day I've taught people from all over here, and I know they are good in whatever they do. Even my own staff, I run what we call Aura and Co. It's very important. I let this information you get to know. I run a company called Aura and Co. It's an audit firm, right? So even my own staff, in this case here, the very best staff who haven't yet cleared their CPAs, who are now doing AAA. Some of them, in this case here, the results will come like this. So then we keep on wondering. As someone who has ever marked these papers before, I'll be able to tell you one of the things, and today I'll only tell you one, not unless you give me more time. But today, the time that I have, I'll only give you one thing that makes students in this case here fail terribly, terribly, terribly. Whether you like it or not, there will be a scenario question on audit risk. A scenario, a case question. So they give you a very big case question, and then they tell you to evaluate audit risks. To evaluate audit risks from the case question. And then they will give you not eight. They'll tell you in this case here, for example, you evaluate eight audit risks like that. Whenever you hear of 8 audit risks, here you are supposed to know that straight away, this question will give you what here? 16 marks. 16 marks. Yeah. And even, for example, when you go to a question, get a question in this case here has 10 marks asking you to evaluate. You describe audit risks, and then they give you 10 marks. Then straight away know that each tick, each point will have 2 marks. So in this case here, you need how many points? You need 5 points. You need 5 points. And then, of course, you are not supposed to write those points like paragraphs. No. Whenever you get any question to do with the audit risk, always you shall write your answer in T format. Audit risk, auditor's response. Audit risk, auditor's response, like that. Now, in terms of audit risk, when you identify one risk, you get 0.5 marks. For every risk you identify that is reasonable, you get 0.5 marks. You explain why are you saying that this is a risk. The explanation gives you 0.5. So you have 1 mark there. And then now as the auditor, how will you be able to now minimize the risk you have identified to ensure that the risk item you have identified will not be having a serious impact on your opinion? How do you respond? So the response here normally will give you 1 mark, 1 mark. 1 mark. And those risks, I don't understand why, because those risks, if you look at your past papers all over, those risks are normally the same. I've never seen like a new risk. I've never ever seen a new risk in those scenario questions. They are normally the same. Like which risk? For example, you'll be told that Aura and Co will be auditing XYZ for the very first time. That XYZ is a new client. Is a new client. By the fact that you are a new client, there is a very, very big risk that we may misjudge you. We may not be able to do enough. This is a risk area. New client. Now, ladies and gentlemen, new client automatically, this presents a very, very big risk that you may not be able to dig enough information, be able to audit this guy effectively. Now, even ourselves, for example, the young men who are here, when you see a young girl for the very first time, you met this girl, say for the last 30 minutes, most of us in this case here, we tend to misjudge them very fast. Yeah, you simply look at, for example, the dressing, and then you say, this is a slave queen, isn't it? And this lady could be beautiful even in the inside. All right, all right, inherit. Okay, okay, great responses there. So in this case here, we have a new client. So when you say that this client is new, I mean, why are you saying that this is a risk? Because you must give us the concept of the why. Why? Why? Are you able to give me the reason why a new client in this case here portends a big risk for you as an auditor? Are you able to give me the reason why you are saying that a new client portends a big risk for you? So if you're reading a case question, you're told that Aura and Co has gotten XYZ and XYZ is a new client, automatically you pick that concept of a new client as a risk. So I'm waiting to see what you guys will be able to tell me why you saying the new client is really a risky stuff. Is a risky stuff. We don't know anything about them. Lack of familiarity, no. No experience about them. You don't know them. We don't know them. We don't know them. So, ladies and gentlemen, normally what we do, and you can, I don't know whether this thing will be able to give you, normally do, whenever you have a new client, there is an audit risk since we don't have cumulative audit knowledge of the client. We don't have cumulative. We don't have. We do not have. We don't have cumulative audit knowledge, audit knowledge, audit knowledge, audit knowledge of the client, audit knowledge of the client. We lack that. We lack that. So, for example, we know that their opening balances may not be correct. So, of course, you can be able to say so many things here, like lack of information about them, etc., etc., etc. All right. But now, what safeguards do you put here? What is the auditor's response? As an auditor, what are you going to do? Tell me something to write here. As an auditor, what are you going to do? As an auditor, I'm giving you exactly 1 minute. You don't have cumulative. So should you say that now because you are new, I'm going to reject you because I fear I will make a wrong opinion, and then the client goes, no, they'll never get clients. There must be safeguards. How are you going to respond to this issue? Yeah, background search, background checks, okay. Talk to previous auditors. Yeah, don't take clients in this case here anyhowly. I love that. Minutes, okay. Now, ladies and gentlemen, here the proper response is, as an auditor, if it's a new client, more time and resources. More time and resources will be devoted, to understand the client better. So the first time I'm auditing a client, and this is very, very practical, even at our and co, the first time we are auditing a client, that client may not really give us like serious profits. May not give us like serious profits because we're going to spend lots of time to understand this client. We're going to test like now substantive. So in this case here, use more substantive tests. Use more substantive. Use more substantive what here? Tests for this client here. Use more substantive tests. Use more substantive what here? Substantive tests. You know, substantive tests are the ones that you normally use practically. The RAEOU, RAEOU, analytical procedures. We have an inquiries and third-party confirmation. So like now here and the inquiries, I will inquire quite a lot to be able to gather understanding of this client here. I'll be able to ask in this case here something quite huge from the outgoing auditors. I'll be able to ask their banks. because I want the opening balances here to be correct. I have to do data's circularization. I must do lots of it. Like now, most of the things you guys have been telling me, they oscillate around here. Inspection, observation. I have, like I saw somebody mentioning there, I have to do recalculations. So it is analytical procedures. We have in this case here, inquiries and third-party confirmations. We have inspection, we have observation, and then we have recalculation and what here? Reperformance. Recalculation. So for example, when they tell me that, you know what, I did this bank reconciliation, I'll tell them no problem. I'll have to run through, I'll have to do my bank reconciliation personally. In the other clients that I'm normally used to, I know their level of what here? Proficiency, their level of efficiency. So I don't have to do a lot. Of course, there is also the element of familiarity, but that is a bit better than what here, than having to work with a new client. So like now, ladies and gentlemen, that is really a very, very good thing that you guys should be able to mention. Look at how I'm structuring my answer. Now, from there, ladies and gentlemen, you will be told in the scenario that we have here, what we call development costs. Whenever there are development costs, automatically that's a risk. That's a risk. Development costs. So there is a risk that the intangible assets may be materially misstated. Listen to the language I'm using. I'm not saying that the intangible assets are. I mean, no, I haven't just started testing things. You use the word maybe. So in this case, you know, development costs, chances are intangible. So why are we saying that these are risk? It's because intangible assets maybe materially, in this case here done what here, misstated here. Maybe materially misstated. Now, what they are calling development costs, perhaps in this case, he has not met the idea of, has not met the concept of IS 38. Voice breaking. Oh, we shall overcome. We shall overcome. We shall overcome. Are you able to hear me now a bit better? Are you able to hear Mwalimu a bit better? Okay, thank you so much. Thank you so much. We shall overcome. I'm almost finishing. Almost finishing, yeah. So remember, whenever you hear of development costs, that's a technical thing. Technical thing. Why? Because most of us, we normally capitalize even research costs. And research costs are never supposed to be capitalized. Remember, according to IS 38, you should only start capitalizing this is R&D. We call it research and development costs. When we are seeing some light, when there is a possibility, a higher possibility that whatever you've been researching and developing will see the light of the day, will be sold, for example. Now it has gotten to that point where we can see that this thing, we've been making this vehicle up to this level, all right, all along. And perhaps there are even people who are interested in buying. Then this now has to be taken to development as an intangible asset. So then as an auditor, what do I need to do? Whenever I see anything to development cost, as a response, I will simply ask for a break. This is the easiest. You will simply ask for a detailed breakdown of this expenditure. A detailed breakdown of the expenditure. A detailed breakdown of the expenditure. I will inquire from management. I will inquire from management as to the reasons that makes them believe that this particular cost should be capitalized. So there must be inquiries here. All right. If in this case here, there are clients outside there that have developed interest in this particular prototype, we normally call them prototypes, then I will have to look at the documentation. They express in this case the interest verbally, and then somebody is taking this thing to the balance sheet. So the assets are normally what here overstated. Ladies and gentlemen, please listen. If you look at what I'm doing, and this is what kills you. If you have ever done, you'll get students here who have ever done this AA and AAA even 3 times. You see, for example, when you look at your statement of financial position, I see something. Yeah. When you look at your statement of financial position, you have in this case here non-current assets. So non-current assets, you have PPE, you have intangible assets, you have intangible assets, etc. You have current assets, we have inventory. If you look at how I'm identifying my risks, you must always place a risk to a particular component. To a particular component. So when, for example, they give you something like refurbishment cost, you must have seen that. Refurbishment cost. Some refurbishment costs are not supposed to be expensed. Most of these directors will just mention its refurbishment, give you, for example, just one blanket cost item in the income statement. You'll tell them, no. I know some of these refurbishment costs went into making our assets bigger for them to generate bigger revenue. So for example, if it's a lorry that we have, and then we change engine, when we change the engine, this lorry will be able to move faster, will be able to do more work. So you see now the lorry expenditure, the lorry cost, the engine cost cannot be taken as a refurbishment cost. Cannot be a refurbishment expense in the income statement. That ought to be capitalized because it's a capital expenditure. You know, we have what we call capital expenditure and revenue expenses. Yeah, it should be capitalized like that. We have what we call capital. So you need to really, there's no way you'll tell me that this is a risk that will lead to assets being materially missed. Which assets? Asset. If you don't tell us the asset in question, then you get a zero in the entire response. You get a zero in the entire response. So, and we have got so many risky areas. If you look at, for example, you have case questions. For example, we have construction loans. We have a risk in terms of how they are classifying leases. We have a risk, for example, on payable. We have another risk that I normally see every other day that in this case here, sales has been declining. When you see sales declining, that's a risky thing. So then we shall be able to create a class where we discuss now fully, like a full question regarding this. So I shall be able to stop here, ladies and gentlemen, and of course, invite all of you to join RCM's classes here. So if you are interested in joining our classes, this is our number. This is our number. This is our number. So, and remember again, as you sign out, now moving forward, to do CP has been made very, very simple. Yeah. Are you aware that now CASNEB is giving out HELB loans? Are you aware that CASNEB is giving out HELB loans? Our students, about 100 and something students last time, they were able to get school fees. You get school fees of up to 60,000, school fees, 60,000. And then they pay for you exams up to 40,000. You see, like if you get 60,000 paid to RCM, if you get 60,000 being paid to RCM, this will be your fees, say, for 4 semesters. All right. And then we'll start paying this loan when you clear your CPA. They've given you a 3-year period where they will not, in this case, here, call you to repay back their loan. Yeah, most of the university students don't have a problem with these loans. They have known that HELB is quite a nice thing. So you need to consider taking this. This will really help you. Yeah. So that is it. And if you're interested with also these loans, please call this number. Please call this number. Otherwise, thank you so much. Be blessed. I hope you have enjoyed the session. Short but nice. And I hope you guys will be able to pass your exam. You'll be able to pass your exam. So thank you so much. Bye. 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 Great. Bye. Bye.